Hello YouTube, Herman Williams with ATM Financial Services. Here again with another Money Smarts lesson to help you take control of your finances. Now in previous lessons we've focused primarily on managing debt, understanding your credit score, and the importance of having an emergency fund. So if you haven't already viewed those lessons, you may want to take time to do so. But today we're going to move on to something with a little more positive flavor to it. Today's lesson is on retirement planning. First, let me say that developing a detailed, comprehensive retirement plan that is specific to you takes a lot more time than I have in this video. Please seek help from a trained professional in order to develop your comprehensive plan. ATM Financial Services is here to assist you with your planning needs. This lesson is intended to help you get started with your retirement planning so you can figure out what assistance you need. So whether you're just starting your career, nearing the end of your career, or anywhere in between, it is important to have a plan and know how you're going to live in retirement. When I ask people who are currently working when they plan to retire, the most common answer I get is usually a short hesitation followed by something like, 65, I guess. Sound familiar? Well, an answer like that tells me that you really do not have a plan for retirement, which means you're not actively working toward a goal that will support your retirement expectations. What that answer also means for a lot of people is that they're going to work until they are at least 65 and hope that they can retire at that point. Well, I'm here to tell you that it doesn't have to be that way. Let's talk about how we can turn hope into actions. First, let's start with what retirement saving options you might have available to you and how you can maximize those benefits. Most employer-provided plans fall into two categories: defined benefit and defined contribution. A defined benefit plan is a pension plan, basically. The employee contributes his or her blood, sweat, and tears to the job for a period of time, usually at least 10 years, and in exchange, the employer agrees to pay the employee a monthly amount in retirement based on a calculation that takes into account the total years of service, the average pay over that period of time, and possibly other factors. In most cases, you must also be at least 50 years of age in order to begin receiving that pension. The defined benefit is designed to pay that calculated amount until your death. Your benefit is defined solely by the calculation and not determined by any contributions you make because you don't make any dollar contributions to this plan. That's the good news about defined benefits or pension. The bad news is that this benefit is no longer as widely available as it once was. Up until the 1980s, defined benefit pensions were the most popular retirement plan offered by employers. But as of 2018, however, only about 17% of private sector workers have access to a pension plan. If you work for a company that still provides a pension, you should consider yourself lucky. As you can see, most private sector companies have shifted away from pensions and now provide their employees with access to a defined contribution plan. With the defined contribution plan, your final benefit is determined by the amount you contribute, any matching dollars provided by your employer, the rate of return on that investment, and how long those investments have to grow. This has shifted the burden and the risk of planning for retirement to the employee. The problem with that is that most employees are not knowledgeable enough to formulate and manage their own retirement strategy. Now we're back to hoping I can retire someday. Okay, enough about the history lesson. Let's talk about how you can prepare yourself for your retirement. If you have a defined contribution plan, it is most likely in the form of a 401k, 403b, a thrift saving plan, or perhaps a profit sharing plan. The first thing you need to know about your plan is, does it provide a company matching contribution? Most companies that offer these plans will offer some matching contribution up to a certain percentage of your salary. Some companies match your contributions dollar for dollar up to the limit. Others may only match 50 cents for every dollar that you contribute up to the limit, and yet others may match 75 cents for every dollar you contribute. Whatever the matching amount and whatever the limit, your first goal should be to increase your contributions to at least the maximum matching limit. This is free money, and you want to get as much of that as you can as quickly as you can. To better understand the value of matching contributions, let's say you currently make $45,000 a year, and you are currently contributing 3% of your salary before taxes. That means that you are putting in $1,350 per year. If your employer matches dollar for dollar, that means they are also putting in $1,350 per year. That means you receive in your account a total of $2,700, and it only cost you $1,350. If the maximum matching contribution is 6% of salary, in this example, you're leaving an additional $1,350 of free money on the table every year. Once you have reached a maximum contribution, your next goal should be to start contributing to a Roth account. Now, you may have a Roth option available through your employee savings plan. It may be called a Roth 401k, and these accounts are sort of a hybrid between a 401k and a Roth IRA. It is important to note several points about Roth 401ks. First, they are still subject to required minimum distributions at age 72. RMDs are an IRS rule that says you have to start withdrawing money from your tax-deferred account at a certain age in order for them to start collecting taxes before you die. The age at which you must begin this process was recently changed from 70 and a half to age 72. RMDs don't apply to Roth IRAs ever. Roth 401ks also usually have limited investment options, whereas Roth IRAs allow investment in almost any asset available on the open markets. Two advantages that Roth 401ks have over Roth IRAs are: one, a higher contribution limit, which is currently $19,500 versus $6,000, and two, no income limit versus a phase-out range that begins at $124,000 for single income earners and $196,000 for married filing jointly. This phase-out is based on your modified adjusted gross income. So the Roth 401k works well for high-income earners. It is also important to note that a Roth 401k can be rolled over to a Roth IRA. Just make sure you follow IRS rules when you do so. There is also what is known as a catch-up provision for both 401ks and IRAs if you're 50 years old or older. For 401ks, you can contribute an additional $6,500 per year, making your total limit for the year $26,000. For IRAs, the catch-up provision is $1,000, making your total for the year $7,000 if you're age 50 or older. Having a Roth IRA in retirement can have huge benefits. When you need to make withdrawals during retirement, having a Roth account gives you the flexibility to take some or all of the money out tax-free. Having a Roth also reduces the amount of your savings that will be subject to RMDs. In short, a Roth account gives you added flexibility, tax-free growth, and reduces your overall tax bill at the time of distribution. Now, the next step in your retirement planning process is to commit to systematically increasing your contribution rate until you reach that maximum contribution limit. Every time you get a raise in pay, commit to using half of that to bump up your retirement savings. If you get a 4% raise, increase your savings by 2%. If you only get a 2% raise, then increase your savings by 1%. You have to think differently about how you manage your money in order to reach your retirement goals. If you are eligible for a traditional or Roth IRA outside of your employer plan and you receive a tax refund, that is a good way to fund your IRA. Again, it's about our behaviors. So what if your employer doesn't offer any retirement benefits? Or what if you're self-employed? You can still start your own retirement account. You can open an IRA account with as little as $50 through Fidelity or any of the other online firms. With these accounts, the trade fees are low and some trades can be made without a commission at all. If you need help building a portfolio, they have different low-cost options that let you choose how much help you need for a certain fee. And you can also link these accounts to your bank account and have transfers take place each month on a date of your choosing. Just be aware that if you start out with less than $2,500, you will likely have to make your stock or fund purchases manually. That's because most of the mutual funds that allow your deposits to be automatically invested require a minimum investment of $2,500. Some are even higher than that, maybe $5,000. Please don't let that discourage you from getting started though, because once you have accumulated $2,500 in your investment account, you can sell that investment and move the money into a mutual fund that allows for automatic investments. Whether you are investing through an employer-sponsored plan or doing it on your own outside your employer, please remember that you need to have a diversified portfolio. You never want to put all your eggs in one basket. There are a number of ways to diversify, and I won't attempt to tell you what is the best mix for you without knowing a lot more about your specific situation, your specific goals, your risk tolerance, your unique timeline, and other factors that are specific to you and your family. Generally speaking, though, you should strive for a portfolio that has a mixture of stocks, bonds, and some cash. What percentage of your portfolio that should be allocated to each is unique to you, your resources, and your goal. In order to determine how much you need to have saved for retirement to ensure you won't run out of money, you really should have a comprehensive retirement plan that takes all relevant factors into consideration. Things like pre-retirement and post-retirement inflation, post-retirement expenses such as living expenses, travel, hobbies, and of course your bucket list. You also need to have an understanding of your life expectancy based on your family medical history. All of these things are specific to you. Once you have an idea how much money you will need, you can then determine how much you need to be saving and what kind of return you need to earn in order to meet your objectives. This can all seem complicated and overwhelming at first. This is why I take time to get to know my clients and understand their goals, their resources, and what is important to them. If you need my help, please reach out to me through my website or find a financial advisor that truly has your best interest at heart. The most important thing is to get started as early as possible and have a plan. Let's take a quick look at an example of how much difference starting early can make. Okay, let's look at an example of the advantage of starting early with your retirement planning. This is the story of early Ellie and late Larry. Now, Ellie and Larry are both childhood friends, and they both are 20 years of age. They are both single and earn the same amount of pay. They both have a 401k plan available through their employer with dollar-for-dollar matching up to 6% of their salary. And they both want to retire at age 60. Now, Ellie decides that she will contribute $100 a month and she's going to begin immediately. Larry is busy enjoying life and doesn't see the benefit of investing right now. He does plan to start at some time in the future. But Ellie contributes the same amount for 10 years and then stops making contributions. At age 30, Larry decides to contribute $100 a month, and he does so until he reaches age 60. That's a total of 30 years. Now, both accounts earn on average 7% annually. The question is, when they both reach age 60, who will have the most money? Let's take a look at the results. Lazy Larry will have $243,994. Not bad. Now Larry contributed a total of $36,000 of his money, and he received matching contributions from his employer for the same amount, for a total of $72,000. The remaining $171,994 comes from stock market gains and the value of compounding. Now let's take a look at Ellie. Early Ellie has a total of $280,968. Now remember, Ellie started at age 20, contributed $100 a month for only 10 years, and then she stopped making contributions. But when she reaches age 60, she will actually have more money than Larry will. Now where did Ellie's money come from? Ellie contributed $12,000 of her money, and she received matching contributions from her employer for the same amount, for a total of $24,000. The remaining $256,968 comes from stock market gains and the value of compounding and time. That, my friends, is the advantage of starting early. Well, that concludes this week's lesson. As usual, I hope you have found the information informative and useful. Please be on the lookout for further lessons that will help explain the stock market and how it works and how you can use it to build your retirement strategy. If you like this video, please give it a thumbs up. And if you haven't already subscribed to my page, please do so by clicking the subscribe button down below. And until next time, behave well.